Imagine buying your favorite cup of bubble tea here in Taipei. Now imagine arriving in New York and ordering that exact same drink. This chart shows a strange reality. That cup in Taipei costs about 60 new Taiwan dollars. But in New York, the exact same tea costs $6, which equals roughly 180 NTD. You are getting the exact same product, but for 3 times the cost. If things are cheaper in one place, people naturally want to buy them there and sell them where they are expensive. Economists call this the law of one price. In a perfect world without shipping costs, those 2 bar charts would be forced to equalize at the same height. In real life, shipping tea across the ocean costs money, and taxes get in the way. But the economic pressure to balance those prices stays active. That quiet, constant push for prices to match across borders provides the foundation for how global currencies behave. To see how this affects entire currencies, we have to scale up. Imagine dropping that single cup of tea into a massive shopping basket that holds your entire cost of living, your rent, your clothes, your groceries, and your phone. This scale represents a concept called purchasing power parity, or PPP. Think of the exchange rate between 2 countries as the pivot point balancing these 2 giant national shopping baskets. If the price of the items in the US basket suddenly doubles, but the Taiwan basket stays the same, the scale tips. To keep the actual buying power equal between the 2 countries, the exchange rate, the pivot point, has to slide over to restore the balance. A currency's true value on the world stage depends entirely on how much it can actually buy back at home. The exchange rate acts as a mathematical balancing mechanism, constantly shifting to ensure money carries equal purchasing weight across the globe. The main entity capable of disrupting this global price balance is a country's central bank, because they control the supply of money. Imagine the US central bank decides to aggressively print a massive wave of new US dollars. Flooding the market with new dollars to chase the same amount of goods causes domestic prices to rise. This is the monetary approach. More money chasing the same goods creates inflation. Because everyday items in the US are now more expensive, that US shopping basket gets heavier. It loses its balance against the stable Taiwan basket. To restore purchasing power parity, the scale has to adjust. The US dollar must lose value, or depreciate, against the new Taiwan dollar. Printing excess money weakens a country's currency on the global stage, simply because it destroys local purchasing power. This brings us to a puzzle. If you hear that a US bank is offering a very high interest rate, does that mean the US dollar is getting stronger? Over the long run, a soaring interest rate usually signals a weakening currency. This happens because of a concept called the Fisher effect. Banks do not set their interest rates randomly. They base them heavily on the inflation they expect to see in the future. If banks anticipate that future inflation will eat away the value of the money they lend out, they have to defend themselves. They raise the sticker price of the loan, what we call the nominal interest rate, to protect the actual value of the money they get back. High interest rates act as an economic warning siren. They tell us that banks are bracing for heavy inflation on the horizon. Since high interest rates signal incoming inflation, and inflation causes a currency to lose its purchasing power, a spike in interest rates actually predicts a weaker currency in the long run. This flowchart shows the chain reaction. An increased money supply creates expectations of higher inflation. That expected inflation triggers the Fisher effect, forcing banks to raise interest rates. Finally, the currency depreciates to maintain purchasing power parity. These complex financial news topics are all just cogs in one single machine, working together to keep purchasing power equal. The next time you watch the financial news and hear a reporter say the central bank is raising rates because of high inflation, you now know how to decode the message. This signals your new Taiwan dollars might soon buy more US goods than they did yesterday. You can now see the invisible forces behind global finance. And it all starts with understanding the price of a cup of bubble tea.